Good day, fellow investors. The goal of investing is pretty simple. We want to turn the dollars we have into much more. Thus, we are discussing investment performance, and the question is at what investment return it is worth to invest or not to invest. And in this video, I want to discuss whether we can get to double-digit returns per year that makes investing worthwhile, a life investing hack that will give you a great perspective when it comes to investing or not, how I got to 15% returns per year over the last 20 years, just my story, but I think it will be extremely helpful. What are the factors there? And then my plan and outlook when it comes to investing now. I think that everybody can do well for oneself when it comes to investing. So let's start with how I did really well for myself in the past. And the key is, of course, mindset. You have to understand that it is a process. Investing is a process that goes through your life. And if you understand that process, everything gets much easier. And part of that process is that things are also not linear. And we'll dig more into that later. So, my story, I did really well, as I said, and now I also see the comments, yes, but this. My point is not to brag here, just to show you what I followed, the strategy that led me to results, and maybe you can apply that strategy to your situation too. I've started investing now more than 20 years ago in 2002, then there was a boom, sold. 2010, 11, I started again accumulating as much as I could because the situation was good. And then the third stage of my investment was recently, since I do everything, let's say, publicly on my research platform. And the thing is that in 2002, 2010, I bought stocks and those went 5x, which led to great returns. From 2018, we are at a 2x, let's say 1.8x, so still good, not stellar as it was, but still good, and I think I can do even better as I did in the past if I focus in the future on the right factors. And the first factor is, when it comes to investing, is that when I invested in something and did really good, I liked the business for what it was without the hope that the stock will go up. For example, in 2010, I invested in this, which is a camping site. And let's look at that camping site. It's called Tourist Hotel, and I now found finally somewhere to get good data on companies, which is ticker. Global companies, very few services do that. And you can see here also the long-term stock price, and I started investing here 2010, and I remember every salary that I got, I would put it into stocks here. So by 2012 I had a good chunk of that, and then the market improved, crisis in Europe passed, and it, let's say, 5x from the start here, plus there were some good dividends reinvested, so I did a 4x here. And I started selling here when we bought a house in the Netherlands, moved to London, and for private reasons. Since then, it didn't do as good, but let's look at the factors. So I was buying here, and the stock price was a quarter of what it is now. The market cap then was around 400 million. Why is this important? If we look at the long-term financials, you will see what was I buying. So here we go, income statement. You can see that I was buying a business that doubled its revenues over the last 10 years. Nothing fancy, slow and steady growth. They were expanding, investing, and if we look at net income, so that didn't double much because such businesses, as I have shown you the picture, are capital intensive. Thus, there is a lot of depreciation that lowers net income, good for taxes. But then again, if we look at the cash flows over the period that is always a big positive from operations, and you can see how that also doubled, that they can then reinvest for more. But back to the income statement, if we look at it, when I was buying it, the market cap was around 400 million and net income was around 40 million. So that's a price earnings ratio of 10. Nothing stellar, but with the growth ahead, I knew that the business was good and they paid the fancy, nice dividend of about 6, 7, 8% that I could reinvest. So the factors are there: low P ratio, good business, growth business, steady growth ahead, and then you just leave it to the market to go from P of 10. When the earnings double over time, then also the market likes it, so that's a double, plus the market likes it, gives it a P ratio of 20 like it does now, and there you have already a 4x. Plus there were good developments, a highway was being built, so more tourists coming, growth, slow and steady, nothing spectacular, but it was a good business. And that led to the great returns in that period. Since 2018 I started the model portfolio on my research platform. That did also well, not as well as the other example that I showed, but that was my fault because I made too many mistakes, but still it did well. So the platform portfolio was started in May 2018, 4.5 years have passed. It was started, I adjusted it a little bit, but 5,000, and then I add monthly 250. And the value now is at 26,500, so I started with 5,250, have been doing that for 4.5 years, and 14.5%, if I calculate that, that's exactly the return I have achieved over the last 4.5 years for contributions of 18,500. Nothing stellar, nothing bad also, but I hope I'll do better in the future because I also show you now the factors that are in the portfolio now that should lead to better returns. But also keep in mind, if I keep doing that and I do that over 20 years, that's actually what is the key here, because the compounding then really starts in, because what you invested and compounded starts giving you return on your investment, interest on interest, and then over the long term, the real difference should kick in. So what are the factors that I'm looking for that I think will lead to, again, good returns from now and for the next 50 years for me, hopefully? In the portfolio now I have 7 positions, and if you look at this position per position, you can see that the P ratio is around 10 for most of them. One has a higher P ratio, but when you normalize for what should happen when pandemic situation still normalizes, that's then a P ratio of 7. And then also 7% growth ahead, 5%, 7%. There is one with strong buybacks that is 10% of the market cap. So nothing crazy. There is one good dividend yield with growth. But this, whatever the market does, I can expect a return of 10 to 15% from a business perspective. And that is the key factor that I am working on. For example, if I have a price earnings ratio of 10, 100 divided by 10, it's an earnings yield of 10%. On top of that, if the business grows 5%, that leads to a 15% return over time. And of course, you have to know the business, but you also need to have the right mindset when it comes to investing in this. And the right mindset is the one of owning businesses, no matter what the market does. If you can understand that, then you can invest well for the long term. Now, you have to focus on the rewards as an owner. So how does a business reward you? What's the reward function it has? That can be dividends. That's the easiest. Some businesses just do buybacks. So Apple lowering the number of shares outstanding to increase the value of the share, the stake in the business that you have. And then there are others that simply reinvest the money and create new value through reinvesting. So you have to understand how does it create value for you, and then how does that fit you? And if you like how the business creates value compared to the price you are paying, then you understand the function there. And as long as the business does well, you don't care about the market, which means that you are buying when you are happy with the business reward. Imagine you are buying a business that's not traded on the stock market. That is the way this becomes extremely easy. And now there is also a life investing hack that many forget about, but I think it's crucial when it comes to investing, especially good investing. You have to think about the return on investment versus life benefits. That's something completely disregarded, but core about investing. Because if we look at the general stock market chart that you learn at school and everything, stocks always go up. Just put your money in stocks and you will do well. Well, that is right. Stocks do always go up, but not that fast. If you look at this chart, you can see that there are long periods, 12 years, 17 years, 25 years, 22 years, where stocks go nowhere. Thus, if you invest because stocks go up, then you lose. And especially at this moment, when the price-earnings ratio of the market is 20, which is still higher than the historical average, especially if we look at the long-term price-earnings ratio, taking into account 10 years of earnings, it is at historical highs. It is just where it was before the Great Depression and the great stock market crash here. And the fact is that when the 10-year price-earnings ratio is close to 30, over the last 100-something years, returns have been around 2% on average per year for the next 10 to 15 years. So that's not really stellar and definitely not the 10% that everyone is promising you. And the problem is that if we look at the market with the price-earnings ratio of 20, 100 divided by 20 is 5, plus 2% the average historical earnings growth, that is a return of 7%. Given that inflation is at 4 or 5 and will likely be at that level for the longer term, you don't really make much with investing just in the market now. And if we look the table here, you, yes, double your money with 7% over the next 10 years, and I think that is a very bullish scenario for that to happen in the next 10 years. And now the question is, maybe it is better to put in a new kitchen, for example, compared to doubling your money in the next 10 years. Maybe it is time to buy a new car. Maybe it is time to travel, especially to Europe, as the dollar is strong now. So think about that. And this is what I think many miss when it comes to investing. Investing is about improving your life. And then you have to decide, okay, what are my likely returns versus the value of the money to improve your life. Now, what's the point in having billions when you're 85? In my opinion, nothing. So you have to always compare that, okay, when can I get to a return? And now you might say, Sven, yes, but this might be too greedy. And I've thought about it, and I think there is a difference between greed, especially if we start thinking about short-term greed, okay, I want to put my money in and double it fast, versus long-term greed, I want to double my money in 5 years, not fast. With short-term fear, I don't want to lose my money, but I want to do well over 5-10 years. And if you can have that principle of not doubling my money fast but slow, then it is a big difference, and you have a different mindset than many others out there. So let's discuss my plan. As you have seen the portfolio values there, it is likely that the businesses will deliver double-digit returns. Some will, some won't. I'll certainly make mistakes, but on average, some will deliver sooner, some later. So if I can manage that, I can still do a good return over time, hopefully. And especially now from January, I will start investing 50% of all the revenue that I make from my research platform into my long-term wealth accumulation vehicle, because I'm now at a stage in life where I am ready to do that properly, moving 3 times in the last 10 years and things like that. Now we have settled, stabilized, start, and now investing versus life benefits. I see a lot of benefit in investing, especially because I really like all of these businesses. Then I will have to decide which ones I'll put into my own personal portfolio compared to the model research platform portfolio. But you have to understand nothing is linear when it comes to investing. The market is ugly now. It can remain ugly for the next 5 years, which means that even if you invest in good businesses, it can be a zero return. But if you focus on businesses and that business does well over the next 5 years, it doubles. From a business perspective, you will be even happier because you can buy more of that good business that is now double the value for the same price. That happens when it comes to investing. Usually everyone else panics when that happens, but that's life. And then the goal is that if the business doubles, imagine no stock price, then you have doubled your money no matter what if you don't focus on what Mr. Market thinks. As said, not linear. Perhaps it's even better that it does nothing for 4 years and then jumps in the 5th year because you can reinvest those dividends, add more income to something that leads to a better return. The key of my investing is to find good businesses, but also to minimize mistakes, which, despite the good performance over the last 4.5 years, I have made too many, and that's my next goal. Good businesses and less mistakes. Check my mistakes video for more insight into that.